Hello, everyone. Welcome to the Nest Egg Builder Show. So today we're actually going to be focusing on our audience and different projects that they have. And we're going to make this more of a roundtable today where we are going to do questions and answers and see how we can help everyone grow here. So with that, if anyone would like to speak up and talk about a project that you're currently working on or a challenge that you currently have, we'd love to be able to kind of roundtable that and see what we can do to help you with that, or just encourage you where you are today with that. If you would, just to help me kind of moderate, just go into reactions, raise your hand. That would be most appreciative. And I'll go around and work with everyone.
I have a project that was interesting, but it's not. It was a business loan, and so it's not really real estate related. If you want to hear about just different ways of accessing capital for your business as an investor or any other kind of business, when you need something, when you need cash, there's some other options available.
Okay. Yeah, I think there's a lot of people, they're always interested in accessing more capital, so that would be of interest.
Okay. I had worked with a client a couple of years ago. That view, I don't know what it's all. Are you doing something with that the second screen, Cliff?
I'm not.
Oh, okay. At any rate, I had worked with a client a couple of years ago. He installs HVAC, heating and air conditioning equipment, mostly commercial. He does some residential, and he happens to be in the San Fernando Valley. And he had gotten a couple of jobs where he needed to have a truck with that big crane so that he could get to second and third stories and install it right there. So he was not that familiar with a lot of things, a lot of finances. And we had come up with, there were a lot of things, as you say, Cliff, there's all kinds of little things that come up. He hadn't paid some taxes, so I said, we can't go any further unless you pay them. He got up and ran over to the IRS office, and he paid their taxes. And every time something came up, he would say, well, why? He chose a truck, but it was too old to be financed. So I told him that. He said, well, why can't you finance it? I said, if you wanted to buy it and then you ran into trouble, it's too old. Find another one, which he did. And everything that came along the way, he was questioning, well, why this? Why do I have that? Oh, I need insurance. And then his own insurance broker didn't insure trucks and so forth. And so somebody out there helped us get the insurance that he would need for that big train truck. The only reason I'm bringing that up is because he was upset about everything. And I had to do a lot of educating him what goes on in the finance arena. Anyway, we got over that hurdle. And I was kind of reluctant to reach out to him again. I did a couple of times just through an email and through his not attorney, his accountant. And recently he called me. Well, he had called me for some other kind of funding, which we didn't do. So he called me recently, and he had received a government contract for $800,000. That's a nice piece of cheese. Well, he wasn't he wasn't affected very much by the pandemic, so he was marching right along with his business. But to handle an $800,000 job all at once, and it had to be completed within a certain time frame. So I had to look around for somebody that could handle him being able to get somewhere around 100,000 to be able to buy the materials and the equipment and hire the additional workers to do the job. Well, he didn't have the greatest credit in his credit report, because he was always doing something or other and maxing out things, his credit cards. And we had gotten him some other funding, I guess it's some PPP funding. That was great. It helped him, but he ran through it. So now he needed money. So I found someone who said, okay, it's a high risk, but we'd love to do the deal. And when little things came up, and I would call and I'd tell him, we need this, we needed that. He says, oh, okay. And I was surprised. Then at the last minute, they were supposed to do the funding. They said, oh, well, we need January's financials. So we got January's financials. Now it's coming to the end, pardon me, the end of February. We needed that. And I said to him, look, things are always happening at the last minute. This is what they want. Can you get it for me? He said, yeah, I'll get it for you. And he was just calm, and he wasn't questioning. He wasn't getting all upset and all rabble-roused and so forth. Anyway, it was the funder was really a bit of a jerk. He kept asking for this, and then he got a list of accounts of deposits, more recent deposits, and funding was supposed to go through on a Friday. It didn't go through because there was a cutoff date and it was too late. Then the funder asked for, you had these 4 deposits, a sizable amount for what was normally his deposits. And there wasn't any notation. So he said, what are the sources of those 4 deposits? Oh my God, I thought the client was going to go into a rant again. And I said, he has that. Well, they did it on a phone call rather than, typing it out and sending it via email or text. And so anyway, he got the information to the funder. The funder said, okay, I got it. And guess what? The funding went through. And we got him just under 100,000. They wouldn't get it. The reason I'm saying that is because even in any real estate deal, every single situation is different. And every funder, every person in the deal is going to be going to have their own little quirks. And you've got to expect the unexpected. And
so I'd imagine some things that might help with that, Marcy, might be when you're first working with a lender is asking a series of questions like, what are you looking for from me? How do you actually determine how much I can borrow?
Well, actually,
what information will you need?
Yeah, what happened was I put it through this one funder, and it was a little too risky for his firm. So he contacted another firm. In the meantime, I didn't know that. He hadn't explained that to me. So there were people that were added on to, sometimes you just shut up and a little later on you say, well, who is this person? But sometimes you have to ask, and you're right. The next time I will do that if it's somebody that I haven't worked. Well, I had worked with the one funder, but he had to call in a second funder because he couldn't handle it. And so we called in the other one and he's worked with that other funder before, and everything always went smoothly. And why something was happening in the background that probably my original contact didn't know about, because there was something going on. There was no need for that. He should have told us. We're good. I know that they ask for, many times they'll ask for the financials and the bank statements and so forth. But they won't ask for the copy of this, or let's get it, be able to get into your bank account, which they have to do in the last minute in order to ACH the funds. But you know that they're going to ask for this detail and that. At the last minute, they ask for his license. Well, they should have asked for that before.
Yeah.
Sometimes we're not going to ask for driver's license or something until we know that it's getting closer. We're going to have to need that, because if your list is this big in the beginning, it's a bit overwhelming. So give them the essentials that they're expecting, and then let them know that there will be additional documents that the funder will be asking for as we get, once they say, yes, we can definitely do the deal, and here's the range. When they give us a proposal, a term sheet, then we know, and the client accepts the term sheet, then we know there's going to be some other little details that will be coming up, but not this many details.
Yeah. I work with a handful of private money lenders and also hard money lenders, and referring business over to them. I've been doing it for a while for them, so they have let me know what their criteria is. So I have different things that I'll actually ask the person before I refer them over, to understand, what type of risk that they're going to be, to understand what type of experience that they have, understand what asset class that they've been working in. So are they working in single family homes, and now they want to actually get a loan for multifamily, but they have no multifamily experience? Then I'm going to ask them, well, who are you bringing into the deal that has experience in what you're moving into? I mean, you have deal experience, but not in the asset class that you're looking for. The time that they've actually been doing it, how many successful jobs that they've actually completed. So I ask all those things before I make those referrals.
In this situation, knowing what I know now, I would go ahead and ask a lot more questions in the beginning from my contact, but sometimes it's a first time that I've gone through this kind of a thing.
Yep.
And so now you've gained the experience. Now, I mean, my contact in his firm, he was so upset with the funder, but I didn't want to screw around and try and take it elsewhere, because then we'd have to start in the beginning, and we were so close. But it finally went through. But it was handled poorly. Every time they would always CC me, copy me on all of the emails going back and forth, and I had to intervene a lot of the times to explain what was needed, why, what was going on, and and every now and then I would call my guy and say, "What in the heck is going on?" He said, "I don't know. I'm going to find out." So it wasn't the best of deals, but the client was so happy that he got the money instead of messing around with all the stuff he had. Now he can get to work doing the job and being able to start to pay back the loan. It was a short-term loan.
That's great. So it sounds like you kind of facilitated communications in there where the lender really wasn't fully communicating what was needed. That's really good. So you helped make that deal happen. So you're a pretty.
Oh, absolutely.
Yeah.
If I hadn't been there and intervened, and I missed one of the Peggy's, one of the shows, because I was busy going back and forth with the emails and the phone calls. It was outrageous. But we were focused on, let's get the deal done.
Good job. It sounds like you did it.
Yeah, we did.
That's great.
I think, though, what you just said, some time ago, I was trying to help somebody get some funding for a fix and flip. And she was a terrific lady. She had a job, but she had paid a boatload of money to take a course in fix and flipping. And she had worked with a couple of people and got everything together, but she was never on the paper. On the terms.
Her name didn't go onto the deal,
right,
in any way.
So yeah. I didn't really know at the when I first was working with her, because she always was able to answer all of my questions. And it turns out I hear time after time after time that a funder is very reluctant to work with somebody who hasn't had the experience and their name was never on the papers.
Yes.
How they just have to work hard and get their name, be part of a deal to get that experience. And
that's very true, Marcy. I mean, when you're first starting off, you may actually not be compensated as much as you would be if it were your own deal.
Yeah.
But the most important thing is to get that experience, get your name on a contract, get your name in the LLC, so you're actually part of the deal on the GP side, and you've got that experience. And you need a couple of deals at least under your belt for that particular asset class before you can go out and start getting money on your own. And once you start playing in the larger space, it might require you to have the same net worth in assets outside of what you're currently wanting to borrow in order to even qualify for it.
Yes.
So even if you have the credibility with experience, you still might need to bring an outside sponsor in that has the net worth to cover the opportunity so that you can qualify for the lending that would be required for that deal.
Mm-hmm.
Yeah, absolutely. Well, thanks, Marcy. That was an awesome story.
Good. Glad you liked it.
Thank you. So who else has something that they're working on right now that they'd like to share? Tony, did you unmute? Okay, so if nobody has anything, I could share some of the exciting things.
I might got something.
Oh, go ahead, Elijah, please.
I don't. So it's nothing substantial yet, but and I don't know if anybody in here, if they buy apartment complexes or anything, but talking to my first guy about it's a 10-unit apartment complex, and I know some of the general things to be looking for, but if anybody has any experience on what from their experience of things they failed at or seen when buying it for themselves and making offers and everything.
Have you underwritten any type of multifamily before?
I have with people, but never on my own. So, and I don't even have the numbers exactly yet. All I know is it's 10 units and an approximate price. I'm going to have a conversation with the guy on Friday about that. But he's, looking to sell and looking to move forward with something.
Okay. So
I just want to come in prepared.
Yeah. But before I say anything, would anyone like to chime in on this? Go ahead, Ted.
Kind of a basic question relative to your multifamily. Let's say if you were, looking at a, 5 or 10 year time horizon out ahead, where would the typical occupant of any of the units be presumed to want to work? Where would the jobs be? Where would the tenant's source of revenue come from?
Great question. Yeah, it's very important to understand, what jobs are supporting the market that you're going to be buying in. And Ted, that was excellent. So have you actually determined where those jobs are coming from in that area? What type of
I haven't yet, but I probably could. I I know according to him, it's renting for well under what it should be renting. I think he says he thinks it's somewhere around $650 a month or so. They're 2-bedroom, 1 bath, and 2-bedroom, 2 baths. So, kind of your lower to middle income type person, I'm guessing. But I don't know the exact industries right in that general locale that the jobs might be for, but that's a really good thing I think.
And the trouble is the response that you made didn't answer the question I asked.
Yeah.
What you fundamentally said is, I don't know, the question I asked.
Yeah, that's right.
That's something you need to know, because as a practical matter, your source of income is dependent on the source of income of your tenants.
Yep.
Very true, Ted. Yeah, and right now, the tech industry has been going through some challenges, and a lot of people have been laid off. So, if right now your tenants are all tech-based tenants, which they may or may not be, but if they are, that could pose a risk because, as more companies are laying off people in the tech industry, you may find a higher than normal vacancy. Anyone else want to chime in? Okay. So some of the other things you might want to look at are the classification of the property and the classification of the area. So you're going to have, for your classification of property, you're going to have A, B, C, D, and the same thing for the property itself. So the area and property will each have their own classification. So if it's a newer property, it's probably going to be class A, up until about 10, maybe 15 years of age. Usually it's about 10. Class B is about probably 10 to 20 years. C will be 30 plus. And then D can actually be a property that you really don't want to tackle because it requires too much, work and effort to turn it back around. That's almost like uninhabitable. So those are going to be your main classifications. You can have a C plus property, so it can be an older property, but in really good condition, well maintained, good tenancy, so it might be a C plus property if it's an older property. And then you've got areas also, you've got A areas, which, your areas are going to be in areas where you're going to see a Starbucks in the area. Your A, B areas are going to be areas where you're going to see your Lowe's, Home Depot in those areas, Dunkin' Donuts. C areas will not quite have the same amount of amenities. They might be close by, but they're not in the area. And then a D area is going to be a war zone, likely. But a D area could also be a very heavily gentrified area with low crime. So that means that if it's a D area, you really need to have boots on the street and walk it, walk it during the day, walk it at night, walk it on the weekends. If you have a feeling that it's risky for you to be out there, make sure that you're not alone. But you need to understand the area, that you're going into if it's a D area, because in some areas of the country, like parts of Connecticut, there's a lot of D areas that are in Connecticut, but they're not bad areas. They're not high crime areas. So a tool that I recommend using is spotcrime.com. And that's a tool where you can actually see what type of crime and the frequency of those crimes in the area. As long as they're not violent crimes, it's not as much of a deterrent. I used to live in St. Petersburg, Florida. And in St. Pete, Florida, within a mile of where I lived, crime was just rampant. But it wasn't violent crime. It was stupid stuff, like people would get in a fight, steal money from somebody, vandalism, but it wasn't a shooting. It wasn't a mugging. So nothing like that. So the type of crime that was occurring in the area had an impact as well. So understanding the area that you're going to be in is important. And when you're pricing this out, find out what the comps would be. So if this is 10 doors, it's probably going to be underwritten based on comparables and not based on NOI or net operating income. So you want to find properties that are in a similar type of area and a similar type of property and use that as comps. And when you're doing rental comps, you're going to want to find out if what they're saying that it's under market value. You want to look at what like properties in the area are actually renting their properties for. You can do that a number of different ways. An easy way to do it, you can go on, I think it's apartments.com, and you can look at what apartments are renting for in the area, or even better, call up the other apartments that you're wanting to get the unit comps for, and let them know, hey, I'm considering moving in the area. What are you renting your units for right now? And then if they say, well, we have no vacancies, well, when they become vacant, what will you be renting them at? And then that'll give you an idea. So those are a few things to look for and look at when you're evaluating this. You need to have a good handle on all your expenses, that are going to be in there, and the income. If it's a 10 door, they may or may not have good records of what they're taking in. So you want to make sure that you're able to get good records. And if they don't, if you want to be patient with them and work with them on assembling everything to pull together good records, it might be worth it. You might get a better deal out of it, because most people won't do that. And Tony, I saw you light up for a second. Did you have something that you wanted to add in there?
No, my phone came crashing to the floor, so I had to pick it up. That's probably what it was.
As long as you didn't come crashing to the floor, it's all good.
Yeah.
All right, good.
Went around the corner a little too fast, I guess.
Okay. Well, good. I'm glad you're all right. Does that help out some, Elijah?
Yeah, no, that definitely does. You mentioned something about valuating based off NOI versus comps. At what point would you start going based off of NOI? Like, is there like an approximate size of building or something, or asset that you would switch over to doing it that way?
Typically, when I've underwritten, it's somewhere around 20 to 40 doors. It depends on the area,
Okay.
but you can also talk to the realtor that you're working with, and the realtor can kind of guide you, how they're pricing the property.
Okay.
Yeah, and if you want to price, like when you get into pricing based on NOI, that's going to be more based on your income and your expenses to determine your NOI. You also need to know the cap rate. You're going to need a good underwriting tool so that you can go through and evaluate the property. The underwriting for something like that is a lot more sophisticated than just underwriting something you can do with comparables.
Yeah.
Doug, did you have a comment?
Yeah, actually, that was going to be mine. Because I was always in the impression that once you got over 4 doors, you crossed out of single family and into multifamily. And then at 5 doors or more was when we were evaluating it based on the NOI. So it became very important for us to understand what the expenses and the incomes were. So I agree with everything that you mentioned, especially about walking the neighborhood. Regardless of what class it is, I would still encourage you to walk the neighborhood so that you are very familiar with the type of, traffic that's going in and out of the property, the type of people that are around the property, etc. That you're very comfortable with that. And 9 times out of 10, if he says, well, they're renting under market rates right now, and you can probably cross out, class A property, you're in a B, probably a C class, and you just need to know why. Like, okay, so is it that they're under market value because there's lots of repairs that need to be made? Or are we going back to Ted's comment that the tenants just can't afford more? They're in a situation where, okay, the property is well maintained, but the job market doesn't support them to be able to pay top rent, here. So those types of questions definitely need to be asked and addressed.
Yeah, and to tag onto that, Doug, I mean, you're absolutely right. Once you go from 4 doors to 5 doors and up, once you're at 5 doors and up, it becomes a commercial opportunity. And it's going to be important to understand your income and expenses, regardless of the number of doors. It's just actually underwritten a little bit differently once you actually start underwriting based on net operating income, cap rate, income and expenses. So, for example, when you get at 5 doors or more, instead of having Pelican bins, for a fourplex or a triplex, you're going to have a dumpster. And instead of having parking space, you're going to have a parking lot. So you're going to have to consider, what condition the parking lot's in. Does it need to be resurfaced? Does it need to be restriped? Do I need to put parking blocks down? What type of exterior lighting does it have? So there are different things when you go from it being a residential property to being more of a commercial property.
Yeah, that's true. So maybe then I would say, in addition to what we're discussing right now, you should probably talk to the owner about how that property has been zoned. Has it zoned as a residential, or is it zoned as a commercial property? Because if it's zoned as commercial, you're going to have to go with the NOI. There's no such thing as doing comparables anymore. It's a commercial piece of property. So that's another good piece of information to understand.
That's great. Thank you.
Yeah,
Does that address
absolutely.
your questions there?
Yeah, I think so. That's super helpful.
So
More to
maybe,
think about.
yeah, for sure. And I think the other thing, I don't know about you, but what's your goal in this in acquiring this property? Is just are you acquiring this for growth because you're looking for a piece of property to appreciate in value, or are you relying on this monthly cash flow? Because then that starts becoming a reason why you would want to move forward or not. If it doesn't support the monthly cash flow that you need, then regardless of all the other factors, then it may be one that you pass on because it's just not creating the income that you're looking for.
I think for me, I definitely want that cash flow. It came up more as calling about a different property, and he said no about that, but he's the guy I've been talking to is the commercial broker, and he said we're actually just about to bring this one up, and so if you're interested, we can talk about that before I list it. It kind of came out of the blue, but for me, it's going to be more so on the cash flow front.
Okay, all right.
And then growth eventually as well, but
Sure.
I think anything with cash flow is I'd rather have that.
Yeah. So good rule of thumb is, a lot of people talk about the 1% rule. So that if you're buying it for, $400,000, then you're looking to have, $4,000 worth of income coming in, but you don't want to buy at 1%. You want to try to buy at 1.5 so that you can give yourself some room in there to take care of the repairs, handle the gotchas that come up. So don't settle for, he's going to want to sell it saying, oh, well, you can do this and you'll be able to make that. That's true. But where's the property today? If he's going to make all those repairs so that you can do all that stuff, then that's one thing. It's like, oh, okay. Are you going to make the repairs? Well, no, I'm saying you can make the repairs. Okay, well, then we need to talk about what's the property worth today, not what it's going to be worth after I fix it. No, that's my capital going in to fix it. So that's the discounts that you need.
Very true.
That makes a lot of sense. Yeah.
And I would strongly suggest, if you're really serious about the property during your due diligence phase, have a contractor go out with you and take a clipboard and take notes in every single unit. Do not skip going into any unit. Because there could be one particular unit that has a leak in it, and they can say, well, the tenant doesn't allow anybody to go in. Well, in order for me to actually make an offer on this, I'm going to have to look at every single unit. So initially you may have an LOI, a letter of intent, as a placeholder on the property, allowing you your time to do your due diligence. So you really want to make sure you have an opportunity to do that. You're going to write that into your LOI so that you have an opportunity your due diligence to actually go through each and every door. And you're going to do that with a contractor. Go and have them look if there's a crawl space, attic space, anything. Have them look at everything, the condition of the roof, and deferred maintenance. If it's 1973 or older, there might be clay sewage that's underneath the building that has to be replaced if it's never been done. Could be collapsed. If it's before 1978, it could have lead paint. So you want to make sure it's been properly removed or abated. So you want to have an inspector, go through with you and just make sure everything is good.
Okay.
Flush the toilets and run the tub at the same time and the sink in the bathroom. Make sure everything is draining properly. And if it's not, you might have a sewage problem. And then, if it's never been done, it might actually require you to get, someone to come in with a small robot and run it down into the sewage to see if there's any cave in or any roots that are growing through the sewage somewhere. And if it's the older sewage, they might have to actually sleeve that. They run a flexible sleeve down through it and expand that to replace, a failed sewage drain.
That sounds great. Yeah. Thank
Okay.
you.
Absolutely. Ted, you had your hand raised a second ago. Did you have a comment on that too?
Doug covered some of the questions I have, but why does the current owner want to sell?
Not quite sure yet. Haven't gotten to that point, but that's a great question.
One of my, so to speak, standard pieces of advice to any buyer is don't pay the seller for his lack of vision.
Mhm.
So he had a really good idea for what to do with it, he probably wouldn't be selling it.
True.
So the
Yeah.
curiosity is, what do you bring to the deal that the seller didn't have?
hmm
What can you do that the seller couldn't do if he continued to operate it?
I
There are
like that a lot.
There are a lot of businesses in a lot of different industries where a new buyer can make a business function much better than the previous buyer because he brings a different set of skills to the table than the current owner does. And as a generality, we can look at every business, including real estate, as operating under the the format of a tripod. One leg sales, one leg production, third leg administration. Sales is the function that makes the promises for the enterprise. Production is the function that keeps the promises that sales folks make. And administration is the part of the business that keeps everybody informed and keeps whoever doesn't belong out. They function like the coaching staff and the offensive line for a football team in the circumstances. And the general idea is to try to do the administrative leg with as little cost as possible. The three primary legs on the prongs in the administration leg are accounting, human resource, and IT. Accounting is what keeps people informed. Human resource is what let's say acquires and manages the personnel for the enterprise, and IT is what finds and manages the technology for the enterprise. And each enterprise will certainly be different in detail, but they will be similar in concept to that. And think about your real estate business in the same way. How do you cover all the bases with, appropriately, and then how do you make all the revenues cover all the costs?
Ted, thank you
Hey,
for
Ted.
the nuggets.
Yeah. Hey, Ted, one quick bit of clarification though, because I like what you said about not paying the seller for his lack of vision, but in what way do you stop from paying that? What exactly you mean by that?
Probably the easiest way to, let's say, to summarize it in the real estate example is that usually a buyer will offer a lower price than the seller has asked. And because if the seller is expecting to get what he's really asking for, then the curiosity is, why can't he run it anyway?
Yeah, base it
If
on
it's
real
really worth
numbers
that.
today.
Yeah, if you know, if it's really worth what he's asking for, why couldn't he run it and get the same thing? There are reasons why, a good business could still be for sale, at a fairly high price. But if that's the case, the issue then becomes is, does the incoming owner, is he able to replace all of the resources that are available to the old owner for why it can be still a good business? And I hope there's nobody on this call that wants to be a slumlord.
Thank you, Ted.
Yeah, appreciate it.
Tony, I see you have your hand raised.
Yeah, I missed part of this conversation. How big's this property this person's looking at?
It's 10 units.
10 units? Is it in a major metropolitan area?
No.
Okay. Because I was gonna say, most people would buy a 10 unit and use it as a rental property, apartment complex. But a lot of these companies, they have their employees going all over the place and they need housing for them. So they go to these hotels, they have dinettes and everything in them, and they charge them, $2,000 a week or whatever for their workers to stay there. Well, you could go to these hotels, write down all the businesses, they're on the side of the equipment, the pickups and whatnot, write these businesses letters and say, hey, I got property in this area. I'd be willing to, rent you for, half the price. So instead of renting a property out, in this case, 10-plex apartment for, $600-700 a month, you can rent this out to them for, $1,000-1,200 a week to these workers that are traveling around and they need places to stay while they're doing any particular project. That was just
That's really smart.
a thought.
That's really great.
Yeah, so if it's in an area,
For
a
some reason,
desirable
I
area,
can't hear nothing.
I was going to say, if it's in a good desirable area where people would want to stay, if the property was signed more like a boutique property, that would work for something like that. I could see where that would be really good. And what I mean by that is maybe a little nicer on the inside, maybe a workspace like a desk, something where they have really good Wi-Fi in there. So they can get a really good internet connection because they're probably going to be working on Zoom some. They might be doing some work online. They need a good connection. That's an interesting thought.
Yeah, I like that idea a lot.
Thanks, Tony.
Yes, sir.
It's kind of a reinforcement of the question I asked about where as a prospective owner, where would you expect the people who would occupy your units get their revenue from? Where do they work? What do they do? What do they do for a living? And I'm surprised that the number of people I talk to in real estate who don't seem to care where the tenants work. That puzzles me thoroughly.
Very good points.
You'd also want to find out information on the current tenants, and how much is the turnover of tenants. You got to find out what's been going on, especially in the last year or 2 years.
That's a good point. I mean, it's important to do a lease audit. Take a look at all the leases that they currently have. Hopefully they do have them and they're not a month to month. If they are month to month, then that's something that you need to create a strategy around putting them on an annual lease soon after you take ownership or possession. And then if they do have formal leases, look at the length of time that a tenant has been in a unit. And then doing a lease audit will also help you understand if there's been a vacancy for an extended period of time in any single unit. And that might actually require a little bit more investigation to find out why that unit's been vacant. If there was any damage to the unit, maybe a previous tenant, or maybe they had to be evicted and then there was work that had to be done on the unit. So that gives you some ideas. Ask questions, on the property. So if you happen to find a tenant that is outside, hey, I'm just curious, tell me about the neighborhood. Is this a pretty good neighborhood? How do you like living here? Just ask basic questions to see what they say, and that might give you some additional insight that you probably won't get from the owner.
That's great. Thank you.
Anything else on that topic, or does somebody have a different topic?
I do. I got something different. How y'all doing?
Derek, go for it. Thanks for being here today.
Yeah, I wanted to reach out to you in regard to I would imagine that it is rare, but do you see cases where people are at 70% LTV and they'll basically have maybe only 30% equity, or maybe even 25, and they're still tapping into that equity to try to use to expand their portfolio?
I don't know if I am really in a position to answer that today. Would someone else like to chime in? Does anybody have any knowledge on that? Go ahead, Ted.
Well, the question I would ask you in the circumstances is, if you can make more money than it costs you to borrow, then why wouldn't you borrow as much as you can?
Oh, the reason why you wouldn't borrow as much as you can, because and this has kind of been a new thing I've been experiencing with using different lenders. So what I've noticed is that now they at one point there were lenders that were willing to go all the way up to 80, maybe even 85% LTV. Now with the market, shifting, then it's 75%, and now it's 30% LTV, fix and flip, and I'm just going to use Lima One as an example.
You change the criteria on me. Question was, if you can make more money than it costs you to borrow, then why wouldn't you borrow as much as you can?
If you can make more money as it costs you to borrow, oh, then you mean just leave it alone? Leave the loan alone is what you're saying?
Borrow as much as you can.
If you're borrowing at 10 and making 20,
right?
Why do you stop borrowing?
Yeah, the arbitrage spread is 10%.
The issue becomes, from the lender's point of view, at what point does the lender feel at risk of not getting paid back? Okay, so there are fundamentally three kinds of capital. There's revenue, and there's debt, and there's equity. The cost of revenue is performance. The cost of debt is repayment plus interest. And the cost of equity is control. Lenders are in the debt space. They want to get paid back with a fee for lending it to you.
Mm-hmm.
Okay. So they're willing to take less risk than you are, which is why the question for you is, can you make more money than it costs you to borrow? Can you borrow at 10% and earn 20? If you can, borrow as much money as anybody will lend you.
Right.
And it makes no sense to borrow at 10 and make 5. That's nonsense.
Yeah, that is, you're absolutely correct. But I think more along the lines of, you know, if you already have a first position loan, I'm looking more towards like, okay, well, now I want to borrow more to make as much as I can.
Does
So
it really matter? Because from the point of view of the borrower, the issue is, are you going to keep your promise to the lender and pay him back plus interest?
right, yeah, but that would be the intent behind that. Should be
Yeah.
as a borrower, that should be everyone's intent.
Well, based on the stories that Marcy was telling us earlier, not every borrower intends to pay back. And
Oh,
I tell lenders I've told them for decades at this point. It says, be wary of the borrower who doesn't argue with you about terms.
oh, well, yeah. Well,
Because
if that's
if
the case, then
he won't argue with you about terms,
mhm.
terms are irrelevant if you don't intend to pay the lender back in the first place.
No, I absolutely agree with you, but you won't last long in this game if you intend to borrow without paying back.
You'd be surprised how many people have done it over and over and over and over again because they find gullible lenders.
Yeah, but you end up you can end up losing everything you put something into because they're just going to take you to court and take the property back.
The people who are out to cheat you know how to play the game.
Yeah, and Ted's right. I mean, I've heard stories about this, and I'm not going to tell you how they did it, but yeah, it can be done, and it's unfortunate.
Oh, see that's a reality I don't even bother to live in. I'm more or less on the lines of I want to establish as many good relationships as I can. So therefore we could do honest business. Honest business, I think, is going to be what's going to help you in the long term. You know, we're talking longevity. So when I'm looking at longevity, I'm trying to figure out, okay, if I know that I'm capable of borrowing more money, and which is going to be able to pay, which is going to be able to give me a return and be able to pay back that lender with interest, then that's what I want to be able to do. So, but I'm just running into some issues as far as being able to do that. So,
What do you mean you're running into
We need to
issues?
recruit more people like Derek.
well, the issue that I'm running into is like right now, me and Tyshawn are doing, we have a contract. We're doing a fix and flip property. The contract is for 200,000, and the AR we did the appraisal, the ARV at 295, and the Lima One, which is our lender, which we already established a relationship with them. We're fully qualified and approved with them. They gave us some terms, and yes, we did argue with them. We did argue with the terms, and they wanted, I think, I think maybe 13 or 14% down as a down payment, and they were going to pay 100% of the rehab cost. Now, with them paying 100% of the rehab cost, we had to pay the rehab for this project somehow turned out to be almost 50,000. So with the $200,000 contract, the $50,000 rehab budget, that puts us at $250,000, and you put that up against the ARV of 295, we end up busting the cap for the fix and flip term, which was at 70%. So because Lima One is only complete after repair budget, they're only going to pay up to 70%. So that means me and Tyshawn have to pay the difference if we want to continue to move forward with the project. So now that we want to do that, it's just getting to the point where it's like, okay, well, now I need more capital because they're only going to go up to 70%. I can't get them to budge on it. I can't get them to do anything. So because that's just the way their rules are set up. So now I'm thinking about, okay, with the other properties that I have, could I grab some more equity so that way I can pull something out to get this deal done and finish this deal? And that's what I'm looking at now. But again, that would mean I would have to get another loan, a secured loan, second position secured loan to sit here to be able to do that. So, but seems like that is not, it seemed like there's private lenders and stuff, but it's not common, I guess, should I say.
So you've already got, it sounds like a
I
hard money
apologize.
loan.
I've got a conflict and got to go.
Thank you,
See you
Ted.
later.
So it sounds like you've already got a hard money loan right now, Derek, right?
Correct.
Okay, and then it sounds like you have some more repair work to do for the fix and flip, right?
Correct.
So maybe a bridge loan. But then will someone be willing to provide a bridge loan for a hard money property that it's not making? Is this your first deal, or have you done other deals already?
Oh, I've done other deals. I've done other
Okay.
deals in the past. So yeah, and I've had a bridge loan before, but it was set up the same way, where what they did is they had gave me, but see, the properties I used, those properties I had owned them free and clear. They gave me the money where I didn't have to make no payments for about 2 years. I didn't make no payments, and they let me use the money however I wanted to use it. And I went and started fixing things, repairing things, stuff, ARVs shot through the roof on all these properties. And then once the 2 years was up, I went back and refinanced out of it because they got to get their balloon payment at the end. And then that's how I got out of that bridge loan that they gave me. But now I'm at the point where the properties I have, I don't own free and clear. So who's willing to give a bridge on that equity that I have? And I would think that that's not common, is what I'm saying. I don't see advertisements for anyone doing bridge loans on that. So
you might want to consider bringing somebody in that has personal cash and seeing if they'd be willing to go in on this and walk away. And if you break even, at least you're not losing. But that might be what it could potentially come down to. It's better to do that than to have to walk away from it yourself and lose everything on it. Just a thought.
Right.
Elijah, you have your hand up. Did you have a comment on this?
Yeah, will people, because I don't know if I'm running those numbers right or not. If it was 200 on the contract and then 50 repair, that puts you at about 85% of the ARV, right?
That is, it's above 70.
Yeah, so
It's
so
well
will
above
I don't know.
70.
I don't know, will anybody will you be able to get a bridge loan on a hard money loan at 85% ARV anywhere?
Not today.
Yeah.
Yeah, you-
Right,
If it were a
but
year
I was
ago, it
thinking
might be
about
different, but
maybe,
definitely not today.
right.
So
But I
I
was
guess
thinking more or less the properties that I already had, maybe bridge loaning the
Mhm.
properties that I've done in the past that I'm just holding on, where I got tenants paying rent every month. I was thinking about seeing about doing a loan on that.
So collateralize those.
Yeah, and then
Right,
move the money into that property,
exactly.
Yeah.
which I guess would be a little bit higher risk, but to get the job done and to not put yourself in the hole might need to be a risk that's taken.
Yeah.
Right. So
The
yeah,
other,
it was
Cliff said
yeah.
as well, and the other option is, getting somebody with private money and even maybe offering a equity stake, or even give them, like, if nobody seems to be coming to the table, instead of giving them, say, 10% on their money, give them something like 20 or 30% on their money. Like, make the deal really good for that person. I know I've had a few friends do that when they've been, in a sticky situation with that, and it works out, and then they have a great private money lender in the future. It's like, hey, I can't give you that 30% anymore, but I can still make your money move for you.
Yeah. Or bring somebody in that has more experience than what you have on your team, that can prove and then come in and do what's necessary to get you out of this mess. I've seen that done as well. So those are the only things I can really think of.
Right. And yeah, and I figured I just, like I said, I just throw it out there just in case someone knows something else that I just never heard of before. So
Is the house livable?
it is livable. It probably, probably might want to switch out the appliances. But the thing is, with this particular lender that we have, they're not going to move forward really with. Well, I guess they could move forward with the project, but they still want that down payment that they're looking for. And like even right now, we've been even negotiating, trying to actually get a second opinion appraisal just to see if they could even ARV a little bit higher to lower our costs. So that is something else that, we're exploring right now. But as we're doing this, it is just dragging out more time. The seller, is becoming impatient, all these different things. So it's, but we got the deal pretty much, locked, closed, and sealed. We just have to finish coming up with that original capital that the bank asked for, because everything turned around when they decided to do send out a budget analysis to go out and review the budget that we submitted, because we submitted a budget at $35K, which kept us at our 70% ARV, and which made the terms perfect for us. But then they turned around, sent out a budget analysis, and the budget guy for the lender said, hey, you don't have this inside your budget, you don't have that inside your budget, these things need to be included, and it just raised the budget, high. But now we're already past the cap of the ARV, so it just, yeah, and so the deal wasn't even originally structured this way. So I'm still trying to sit here and still make it work. So, it's a really it's a really, really great property in a great neighborhood. Like, it's nice. It's in Hampton, Virginia. It's a great property. So, but yeah, I guess when there's a will, there's a way. We'll figure something out.
Mhm.
So.
Could you renegotiate with the seller?
I have considered that, and I did mention that to the seller. I even went over I explained to the seller what the holdup was, and they don't want to do that. They said either we make the deal work with them, or what they'll do is they'll just try to sell it as it, go get a broker and just see if the broker can get the money for them. So,
Yeah,
so
do it
this
as
was
is
more or
sale.
less like yes, yeah.
Yeah. That's something to consider also, but to do an as is sale, you just have to make sure that the place is safe and habitable. If you're replacing the appliances, as long as they're in working condition and safe to use, that could be an option.
Do you think you could get lending for the property for as is? If it's livable, you could possibly sell it for about 200 on seller financing, get a big down payment, and I don't know, 50 grand down payment or something, have that cash in your pocket, maybe even to pay down the loan. And then and now you have a note on the property. And if you got financing from whoever, I don't know, I don't really know the details of who you'd get financing from, but if somebody would lend to you for 200,000, and then if you can even show them the contract you have written up potentially with an end buyer with that down payment to pay them out a little bit up front.
So my only problem that I see with that is, if I did that the way you described it, would I be put some appliances in there, would I be putting a tenant in there as well? And if I'm doing that, then I got to do the construction with the tenant. No, you said no?
No, and don't
The
even do
seller.
any work to it. If it's livable, you could just put it out there, put it on the market, and don't even say the price you want for it. Make it based off the rents and everything and what your loan is. So like say your loan is, and I don't know real numbers, but say your loan is $1,000 a month that you're paying somebody back, and so you just need to get whatever your number is, because there's not going to be any expenses with it. So whatever cash flow you want, because when you're seller financing it, that person's going to be the owner of the home, so you're not having to take care of any electrical bills, you're not taking care of any vacancy, any property management, nothing. Like, that person is paying you as if you're the bank.
Yeah,
just
I think the only reason why that would be a problem for us because our strategy is to try to buy and hold, so
Mhm.
that's the only thing. I think that does work if we was just trying to get into something and then just let it go, but that's really not our strategy. So
you can still make that work. So, you could hold the note on that and then put in the contract that when they want to sell it, then they need to actually give you first right of refusal. And that gives you both control, cash flow, and control of the property at the time of sale.
okay, didn't know that. Okay, I'll take a note of that. That's note taken. Okay, I'll explore that. Okay.
Yeah, because then you make money on the note that you hold and make sure that when you write the note, you put a healthy enough interest rate on the note to where you can actually make something. Probably like an 8 or a 9%.
Mm-hmm. If I did that too, because I know there's people that buy notes. Then if I
Mhm.
did that, then I could not sell that note to anyone. Could I?
Why not? Why not? That's why I say, structure it with a healthy interest rate, because if you don't structure it with a healthy interest rate, it's not going to be appealing for someone else that wants to buy, whether it's a partial, so they might want to buy the front end of the note, the back end of the note, or the entire note. But if you structure it properly and you actually design the note well, then it would be more appealing for someone who may want to buy a part of the note or the entire note.
Right. And you said and add in that first right of refusal in there. So if
Mhm.
they ever sell it, I have to be able to sell it back to me first.
Yeah, so and that could still work out, in the contract. So you have the note that you write on that, and a lot of times when you do a 30-year note, there's a tremendous amount of interest that's paid in for the first probably 2/3 to 3/4 of the
Mm-hmm.
loan. So you can actually use that as cash flow to actually cash flow back to you if you needed to. So you can have some cash. You could sell a part of the note, so you can do a partial and sell it out so you can actually get cash flow and still collect for whatever portion you've retained. And then if you sell the entire note, then the note would be sold under the condition that the first right of refusal remained in your control.
Okay. Okay. Yeah, that makes sense.
Yeah,
Another thought too is you probably won't have a hard time finding somebody to sell it to because there's something on the lines of it, probably even more now, but a couple of years ago it was something like 70% of people who could afford to and wanted to get a mortgage for a house would not be able to qualify. That's when it was easy to qualify. Now it's a lot harder. So there's a lot of people who need homes who have money who can pay the cash. Um, so and Hampton, Virginia, that's not a small population. You got a huge population to work with there.
yeah, and as we're seeing changes in the economy, inflation is really high, and a lot of people don't really factor that in. But when you have 2 years back to back with record high inflation, it's not just this year's inflation; it's the previous year's inflation on top of that. There's a compounding impact, and you have to look at how wages have been able to compete and keep up, and in many cases they haven't. So most people have received about a 5% increase in the last 2 years, and that's just not enough when you have 6.4%, for this January and 7.5% for the January before. That's a tremendous amount of money that people are not really having as discretionary money anymore. So you have to factor that in as well. With interest rates and mortgages that are continuing to rise right now, they recently just went up again last week. It's making it more difficult for people to qualify. So homes are sitting on the market for a longer period of time, which means that as homes sit on the market, prices will be reduced. And when prices are reduced and then purchased, you have new comps, which means that if you're playing the fix and flip game, you run the risk of being caught short where you can't finish and sell for what you initially thought you would go in for. So a fix and flip strategy when you have a market in contraction is very risky.
Yeah, that I absolutely do agree with. But I have a pretty solid team, as far as just getting the job done. I just think my biggest problem with this deal was that the bank was just trying to have so much control over how they want the terms in the deal structured, and they're just not giving me any room to do it the way I would want to do the deal. So it's even to the point I've even looked at other lenders and different and other different options, exploring it, just trying to get away from them because they're just like you said, I guess they're worried about the risk factor. So they just have some tight rules around it. So now we're just trying to find some other options. So
Okay.
Yeah.
All right. Well,
I would just add one thing to what Cliff is just saying. I get, just about every week I get a whole full page ad from a broker up here in the valley, and he's been in business, I don't know, 30 years or something like that. And all the time he has his thing would be about
we can't. What is that? I can't see it.
okay.
yeah, we're not able to see it, but just describe it.
About eight houses or so that either were sold, are in escrow, and how many were sold above asking price. This is what I got this week.
We can't see.
We can't see it. Your background's masking it out.
Okay. Well,
Oh, there it goes.
half
When you
the
tilted it.
size.
Yeah.
It's half the size of a full notebook.
Oh, much less.
There is one house on it, just sold, supposedly 12,000 over asking with multiple offers. I mean, he always had about 4 or 8. I mean, 8. 4 across. 8 different houses that were in some way had just been sold or just came in on the market. I mean, this guy's been around for a long time, does heavy advertising. And I think I met him once a long time ago. Nice guy. But one house from 8 houses every week.
Yeah.
Okay.
Much less opportunities out there.
It's
The market's definitely changing. Whatever market you're in, it's important to have a conversation with the realtors that are in your market and ask them, days on market, changes in pricing, impacts in their local market. And that helps you make good decisions especially if you're going to do fix and flat. It's as things change, you really want to watch it real close.
Well, it's the interest rates they're trying to raise the interest rates to hold down inflation. It's not working at the moment.
Yeah, that doesn't have as big of an impact on mortgage rates, but the interest rates that we buy everything else at. So the 10-year Treasury is going to have a pretty significant impact historically on mortgage rates. And then a little known fact, the government actually started purchasing in mass mortgage-backed securities back in 2013. And, they did that for about 10 years. And then January of last year, they announced that they were actually going to start selling off some of what they had. And then March of last year, they announced that they were actually going to stop buying mortgage-backed securities altogether and continue to sell off. So they started selling about $45 billion in mortgage-backed securities a month. And that's when we saw our first spike in interest rates last spring. And then in September, it was announced that they were going to up that from 45 million per month to 95 million per month selling off in mortgage-backed securities. That's when we saw our second massive spike in interest rates. So it's going to take them many years to sell off the mortgage-backed securities, but the government was trying to artificially stimulate and manipulate the mortgage rates to drive the market. And now they have the consequences of having to figure out how to dispose of it. So that is a big challenge. So I think as investors, we were all taught, look at the 10-year Treasury. That's where we actually can see what we're going to be expecting mortgage rates to do. But because you had this other unknown factor out there that nobody was really paying attention to, because we were watching, the pea under the shell we all were taught to look under. We have another anomaly that's having a significant impact on mortgage interest rates. So I personally don't think we're going to see mortgage interest rates drop back down to where we saw them for at least a decade.
Yeah, it's going to be a while. I agree.
Yeah.
It's
and if they really are, if you believe that they're really worried about trying to get inflation back down, they're gonna have to raise it even higher to get it down. So it's got to go up. So
Yeah, you got to get unemployment higher.
mm.
Yeah, they want unemployment around 10%.
Right. Well, let's hope it don't go that high. That's high. Jeez.
That is very high. Yep. All right. So we have stayed on a lot longer than we normally stay on, and I appreciate all of you hanging in there. It's been a really good show today. You know, kind of off the cuff, but I'm glad we were able to make this show today all about you and bring some interesting topics to the table that we could all work on together. So we'll be on again next week, same time, same channel at the Nest Egg Builder, 2 p.m. Pacific, 5 p.m. Eastern. We'll see you then.
I appreciate it.
Thanks,
Take care.
bud.